Good morning, good afternoon, or good evening, depending where you are on the planet. Welcome to the Monday, the 6th of November, Bull versus Bear webinar. Steve Miley here on the call for Trade Day. Welcome, everyone. Apologies for the very slight late running this morning or this afternoon for me. So welcome, everyone. I'm going to go through kind of our usual run through in here, or our usual run through for a Monday. Monday, I tend to look at what I like to call the shape of the week. We look at the bigger picture view going into the week, what we had last week. Why are we looking at the whole week when we're day trading at Trade Day? I say this every Monday pretty much, but it's because even if you're day trading, one, you should have a good handle of what's going on coming up in the week anyway. I think that's good practice. And then secondly, because if we have a lot of bigger events maybe later in the week, then it's going to change the volatility aspects for different parts of the week, right? So if you've got a lot of big announcements or events second half of the week, then usually means that the first half of the week is less volatile, means maybe narrower ranges, might be more of a consolidation range environment rather than a trending environment. All these things can give a different profile to your trading approach. So it might mean that you either tweak your targets or your stops slightly within your strategy because of the fact that the market is expected to be more or less volatile on certain days. So given that, let's look back and look forward. We'll run through the articles we published from Trade Day. We'll look at some of the articles from the major news wires. And I'm going to park looking at the charts today. We'll just look at those and what we've got coming up for the week. So just looking back before we look forward. So we had the Fed obviously last week. And these articles, so this is the weekly recap and update. I posted this yesterday. So this is in the fundamental reports, which is where you're looking right now. If you're watching this live, that is, given you're watching this live and not on the catch up, or even if you're watching on the catch up on the members area, below where you are right now on the left hand side, there's the technical analysis reports. On the right hand side, underneath where you're looking right now, is the fundamental reports. So these go in on the Monday. So we have both the weekly recap and update, and then we have the macro matters. Now the macro matters is basically, well, the weekly recap and update. It's just a condensed version of this, really, more than anything else. So I'm not going to go through the full macro matters. If you want to look into that, it's in more depth. That's there. That's also posted on. I've put those up in the forums. They go in the forums. They're below where you're looking right now. They're also, this is the macro matters is also published on the public site at tradeday.com. But this is the summary, and we'll just run through the summary today. So the Fed upbeat was slightly more upbeat on its outlook for the US economy at the meeting on Wednesday. And there was, I wouldn't say there's dovishness, but it's a reduced hawkishness. It's still de facto dovishness. There was definitely a step to being less hawkish, potentially indicating that if the data looks okay and if the data's going the right way, they may not need to hike rates again. They're still basically saying we may hike rates again, but there was definitely a slight softening from the press conference, slight more upbeat tone from the statement on the economy. So they maintained, obviously, for the second consecutive meeting. The US Treasury also last Wednesday announced future bond sales. These weren't quite as high as the market had maybe feared, and that kind of helped out as well, because what it means is then we see, there was fears of a lot more supply. More supply equals obviously bigger supply pushes prices down. Prices down in any market, right? No matter what you're looking at, excess supply pushes prices down. Lower prices equals higher yields. So both of these in here, I would say, were positive for both bonds and for both stocks. Remember, the bond market has very much been the dog wagging the tail of the stock indices. So for me in here, this was an important development. It reinforced what we were seeing technically anyway, and I'll come to the charts that we published as well that go out every day. Technically, we spoke about the bond market forming these bases, forming these reversal patterns. And the bond markets, reinforced those through Wednesday last week after the Fed, and then through the end of the week as well, through the other data we have, which we're going to come to talk to shortly. Just on the side, Bank of England, though, things in Europe not so positive in here. The UK, Bank of England left rates unchanged, but they had more of a hawkish tone they maintained, and they actually highlighted fears around recession, where the US were obviously more upbeat and stepped, you would say, slightly less hawkish. The Bank of England stayed hawkish and highlighted concerns about the UK economy, and that's kind of similar to what we're kind of not exactly the same as what we're hearing from the Europe and the ECB. Apple earnings were disappointed though with the big earnings reports we had last week with Apple. I'm not going to go through all the earnings reports going forward in here now. It's a fairly quiet. I will literally dip in today, but I'm not going to cover these in any more detail. We've had all the big tech is out. All the massive companies that really affect the broader indices, and obviously you guys are trading the broader indices. So we're not going to concentrate so much on the individual earnings. I might just dip back in. I think it's not this week even. I think it's the week after. It's right at the end of like reporting season. We get, I think it's Target and maybe Walmart. I think we get right at the end. I can't quite remember, but I think it's those two like big US retail outlets that we get. I think it's Target and Walmart come towards the end of the earnings season. Maybe we'll have a little dip in and look even today, and they can sometimes impact the indices, but I'm pretty sure we haven't got them this week. I think they're the week after. So then also last week we had the US PMI data that disappointed on the manufacturing and non-manufacturing side to an extent. Not only the US in here, and the European data was okay but not amazing, so that was somewhat disappointing, and that's showing the slowdown we're expecting. Right, it's no shock we're going to slow down. Right, rates have been jacked higher and higher and higher and higher and higher over the last couple of years, and obviously the last few months central banks have gone on hold as inflation has come down, but inflation hasn't come down enough yet, and we're just kind of in a wait and see mode. But the economy is still continuing to slow, and that's almost a good thing, because the economy continues to slow, then that's kind of means it's going to help inflation to slow as well. And this is why I think, I said on Friday before the report, we want the report to be not too hot, not too cold, just about right. We want the jobs market. Okay, so the jobs report came out on Friday and it was worse than expected, and that actually helped stocks and bonds higher. Why is that? Because it's going to help inflation slow, right? We don't want, right, the US employment report falling off a cliff, right? So it came out as 150,000 jobs added with the expectation of 180, right? But if that had come in at like 60, like really low, then this obviously means the economy's, really slowing down. We're potentially going to go into a hard landing, which is a recession, and that would be a negative for the economy and a negative for stocks, for example. Okay, but we also we don't really want jobs being above that expectation. We didn't want a number coming in up at 250, because then it means the jobs market is still very tight. A tight job market means upward pressure on wages. Upward pressure on wages then equals upward pressure on prices. A tight job market, it also means that people are secure in their jobs. It means the consumer is going to be very, very strong, and a strong consumer can also drive prices up. So, we have to face reality that we're going to have to slow the economy down, and the employment is going to, a situation could worsen slightly. But that's what we need to happen to slow inflation down. So we want not too hot, we want this Goldilocks kind of not too hot, not too cold, just about right. So that's what we've got, what we kind of had. It was below expectations, but it wasn't drastically below expectations. It means the economy is slowing, and the labour market is loosening slightly. It's not too tight. It's starting to loosen, and we want the job market to loosen slightly. Okay, and that's why I think stocks went high. We said that could be the case when we ahead of the report on Friday, and that's kind of what was delivered. So what did we see last week from the actual markets? Well, we had global equity futures were up, as we know, pretty much throughout, right the way through the week. We've got basing patterns going, but for me, these were being driven by global yields, not only US yields, global yields moving significantly lower, US Treasury reversing down from a multi-year high yields. So we went to higher prices, lower yields last week, and we secured bases. I'm going to look at those when we come to the charts in the chart reports that we put out every day. So the US dollar index moved down from multi-month highs, and then there was a real acceleration after the data on Friday. The US dollar index really pushed lower. The euro, the pound, all doing well against the dollar at the end of last week. Gold actually, even though the dollar sold off, gold didn't really sell off. So gold has stayed elevated and consolidated near multi-month highs. And oil looked more negative and sets up more negative. And that's a positive negative for stocks as well, because lower oil prices are obviously going to potentially lead to lower inflationary pressures. What do we have going on coming into this week? US daylight saving time ended. If you're in the US, you'll know this. What it means for the rest of the world is a lot of in Europe and the UK, we moved the week before. So basically, we're back to like kind of as normal in here. The time differences around the globe are pretty much back to normal as far as I'm aware for the most of the time zones that I'm looking at anyway. What we got on the central bank side? Well, it's a relatively quiet week. Bank of Japan meeting minutes have already been out this morning. Nothing really to report there. We get the Reserve Bank of Australia interest rate decision on Tuesday. Well, that's actually overnight tonight, Monday night into Tuesday morning, if you're in the US and if you're in Europe. And then the main event, really, the big event from the central bank side and really the big event from the US side. It's a very, 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 very quiet week for data on the US. So we get Powell speaking on Wednesday. Sometimes the week after, depending how it falls, sometimes the week after the jobs report, you also get the inflation report. Well, we've got nothing really of real note out of the US. So Powell is speaking on Wednesday. Not only watching for Powell, looking for other Fed speakers as we go through this week as well, right? Remember, up until last Wednesday, Thursday, the Fed speakers were on their blackout period. So the Fed speakers are all going to be out in force going through this week and going forward. And it's going to be really interesting to see how they're seeing the data, right? Are we going to get any of those that are more in the middle ground within the FOMC? Are any of those middle ground who maybe have previously in the last few months been looking to maybe hike rates in December before the end of the year? Are they now giving a slightly more dovish tone? Are we going to get people saying, well, maybe the higher yields that we've had, maybe the concerns about the tensions in the Middle East, maybe all of these things in here are going to, and what's been done already, maybe it's slowing the economy down enough, and maybe that means that the Fed are happy with the way inflation is going. The CPI data is going to be super important. We don't get that till next week. So on the data front, as I say, it's a fairly quiet week. We do get we've actually had European PMI data. We'll talk about that shortly. Out already today. You get China trade data tomorrow, German inflation data Wednesday, and then some UK GDP. But there's nothing in here that really stands out from the US. If you look for here, the US is hardly mentioned in here, or it's not mentioned really. We get Powell on Wednesday. So it's very super quiet in here from the US. So do take a look at that. And in more depth, if you want more depth, go take a look at the macro matters. That's out as well. Okay, go take a look at the macro matters, more depth in there. Why did that not work? Oh, there we go. I've been talking about this a lot about the bond markets reversing to the upside, and they continue that bullish reversal in here. So it's right across the yield curve. 30-year bonds in here. We not only took out these down trend lines at the end of last week after the data, we also just poked above that 114.10 level. That signals a bigger bottoming pattern in here for the long end of the curve. 10 years in here also took out, I flagged these levels back on Friday, took out these, nudged above these peaks in here. Yes, we've dipped back down below them, but importantly got above these peaks here on Friday as well. And then the 10-year similarly above these levels. So we're taking out some really much more important, far more important longer-term resistance levels. So the downtrend lines that come all the way from the summer have been reversed, and these swing peaks that were from October have been reversed as well, pretty much right across the yield curve in here. This looks like almost like an inverse head and shoulders in here, down in here on the short end, on the 2-year. So this is telling us the short end, remember, is more a reaction to what the Fed are doing. So this is that telling us that the Fed are not going to hike, pretty much, right? This reversal we've seen, we've had this push down, lower in price, higher in yields for the 2-year, and that push down in here has been as the Fed sort of continued their higher for longer mantra, and now we're reversing that. So that's saying, maybe the Fed are done, right? Maybe the Fed are done. We're seeing that, and then this in here is like showing that maybe the economy is doing a little bit better in here. This reversal, we're not so concerned about the economy, and obviously that's a reflection was reflected by the Fed at the longer end of the curve, and so then we've seen similar in the indices, right? So there is this positive correlation. It has been the bond market wagging the tail of stocks, and we had a really strong week. You can see in here S&P accelerating to the upside, took out a load of resistance points from the October sell-off, and now targeting this swing high really from October going into this week on the S&P. Similarly from the Nasdaq, coming up to this down trend line that comes all the way across from July and targeting that swing peak. So I think we can hit these swing peaks in here. We haven't got a lot to drive us up there, but also, we haven't got a lot of data coming. We've obviously got Powell on Wednesday, but I think, we might have a bit of a pause day today. But I wouldn't be surprised if going into and through Wednesday through Powell's speech, if we go and have an attack on these peaks in here that we saw previously. Gold, as I say, held in pretty well in here, given that the dollar saw a significant move lower. And then in here, we've seen oil in here completing almost a topping pattern in here. It nudged down at this 80-20 level. You've got this trend line that comes all the way up from May. I think we have a slight bounce in oil. We'll come and have a look at them shortly. But overall, oil looking more negative, and that's positive for stocks as well. What else do I have for you? Let's look at the calendar for today. So we have had some of this further. The European PMI data, the global PMI data was a day behind. Why is that? Because we had like a pseudo holiday last week for All Saints Day was the 1st of November last week in Europe. So pseudo holiday meant that we're a day back on the data, the service and composite PMI data for the Eurozone. You can see kind of mixed in here. So for the Eurozone as a whole, bang in line with expectations. The German data beat, but very, very slightly. The French data missed slightly in here. So, and we look into today, we've got nothing of note coming up in here, as you can see from the US, nothing of note. And if we go for this week, as I say in here, there's really nothing of great significance in here. Why is that not scrolling up? Oh, here we go. Tuesday, if we go, we're looking out for the US data in here, trade data in here from the US. Williams is speaking. No, actually, I don't think we've got any. Do we have any? I don't think we've got any Fed speakers on the roster today. No, nothing on the roster today. We do get some stuff later in the week in here, but you go through in here on the US side, mortgage data, it's all very, very light. Trade data, inventories data, the weekly oil data in here. Williams speaking again in here. We do get, so where is Powell speaking on Wednesday? Don't see him on there, but he is speaking on Wednesday. Powell speaking on Wednesday. So it's super light. Jobless claims data. It's like kind of nothing out of the US. Oh no, maybe I got it. Maybe I've put that in the wrong place. Powell speaking Thursday. Maybe he's Wednesday and Thursday. I'm not sure. He may be Wednesday, Thursday. It might be his address to Congress. We'll have to go double check on that one, guys. We'll look at that as we get closer to. It might be Thursday. I was pretty sure it was Wednesday on the other calendar I was looking at. So he may be speaking Wednesday and Thursday in here. We'll circle back on that. But you can see there's nothing at the US. It's just such a light week on the US side. And if you go to the earnings calendar, you'll see in here, we've got none of the big companies. All the big companies have really reported now. Much smaller companies reporting through this. We get Disney on Wednesday. Might do something, reflection of the global consumer, the US and global consumer. If I go into next week, let me see if we've got any of the big. Home Depot. Yeah, we go. Home Depot and Walmart. There we go. So Home Depot and Walmart. We're going. And Target. There they are. So it is the week after I thought so. Home Depot is the other one that I couldn't remember, but we have Target and Walmart reporting not this week, the week after. So they're going to be kind of interesting. Tuesday, Wednesday, Thursday next week. Some of the retail giants would be watching out for those to see how they've been getting on. How is the US consumer doing? I'm just going to be really quickly run through it because we're getting on with time in here. 5 things quickly to start your day. Hedge funds extended short positions on treasuries to a record. So they're still in that trade by the looks of it. Okay. So that there's potentially a bigger squeeze in here. It's been a crowded trade, the shorts on short positions in treasuries. So that trade probably still needs to unwind. So there's potential still further upside as that trade unwinds because treasuries it's been a big crowded trade to be short treasuries in here over the last few months. Hong Kong summit in here, nothing really significant for us. Musk has revealed a challenge to ChatGPT. Nothing interesting. Stocks edging slightly higher in here this morning and a quiet day. A Fed speaker, Lisa Cook, talking about financial stability. So maybe that could be interesting. What else do we have in here? US job markets calls Fed's own job gets easier. So this is exactly what I spoke about, right? I'm talking about the jobs report in here. As the job market cools down, obviously it's going to get a little easier for the Fed. Okay, stocks hold gains after a big rally on Fed rates. Okay, so there's hopes in here that the Fed may be done. This is all stuff we've covered already. Futures edge up on rate cut hopes. Fed speakers awaited. So we said that we're looking for the Fed speakers. Let me just see if in here it tells us in here when Powell is speaking. Pow. Skip. Fed policy rates, including Jerome, in the coming days. Yeah, so we've got Cook, Williams, and Logan all speaking. Let me actually, you know what? We can go to the Fed. Fed speakers. It's this one here, Fed calendar. It's not these speakers. That's looking back. They have the Powell speaking. What's the date? This today. Here's the 6th. So Cook speaking, 11 a.m. Eastern today. Barr tomorrow, and Waller. And then where are we? Cook. Yeah, Powell is speaking Wednesday. I thought it was Wednesday. Yeah. So Powell speaking Wednesday. And I don't see Thursday. Oh, no, and Thursday. Powell speaking Wednesday and Thursday. Okay, there you go. Wednesday and Thursday, Powell. So that's both days, Wednesday and Thursday. So we'll be watching out for Powell Wednesday and Thursday. Hopes of early rate cuts underpin gains in world share. So it's not just in the US that we're looking for maybe rate cuts coming a little bit earlier. But Barclays in here still see another rate cut, but they're looking, another rate hike. They're looking for the Fed to raise rate in January rather than December. And if we go and look at the CME Fed tool in here, looking for December now, 90% chance of unchanged. So the market does not believe the Fed will go again, right? And the bond market is telling you the same thing in here. But January in here, chances of it staying the same, still up at 85%. So very little chance of them going in January. And now if we carry on, as we showed last week, May, now we're actually getting this is actually moved forward. So this was previously June. It was edging towards May. The first rate cut is now, so we're at 525, 550. This is 500, 525. First rate cut now anticipated for May from the Fed Watch tool, and certainly by June, we're certainly looking for a cut by June. Okay, so by May, so that's edging closer as well. Okay, guys, I'm going to wrap it up there. I'm not going to delve into the charts. Just very, very quickly, any questions, throw them in. But Asia overnight in here has ticked higher after the strong day that we had. Obviously, they're playing catch up with us from Friday. Europe this morning is fairly quiet. A slight dip in the French CAC, but the FTSE, the German DAX and the UK FTSE are fairly unchanged. And in here we have US stocks obviously had a good day last week, and then today pretty much unchanged. But we're up a couple of tenths in here on the futures market. Jim, what time does the London market close? What are you with respect to what, Jim? I mean, the cash market. So the futures markets are open until so they're open till 9 p.m. my time. So that is going to be Eastern. That's going to be 4 p.m. Eastern. That's the futures markets, right, though. Okay, so they go to 4 p.m. Eastern, 9 p.m. That's the futures market. The cash market closes, I think, 4:30 London Stock Exchange, and then there's various other times on the European coasts. So close the actual cash market, London Stock, 4:30. It's at 4:30 UK time. Okay, so if you're Eastern, that's 11:30 Eastern. Okay, but it doesn't have a massive. Those closes don't really have an impact onto the US stock indices too much, unless you get a lot of volatility going into the European closes, but you tend not to get that. Okay. Dominic, were there any news regarding the Gaza conflict that could affect the NQ today? No, nothing really. I mean, obviously it's worsening at the moment in here, Dominic. So by the looks of it, the Israeli forces have encircled Gaza City. But you know what? It's all been, I mean, it's horrible to say. Obviously, it's a terrible, terrible situation, right? But the market is priced in that it's almost priced in worse than we've had so far. And I know it's not good, right? From whichever aspect you look at it at, right? But I mean, it's very contained. It's been very contained, i.e., we haven't had any kind of big anything really big being said from other members of the Middle East, other Arabian members. There's been a lot of diplomatic efforts in here from the US and from European leaders, and it's not got worse. And as long as it doesn't get worse, then the market's okay. But you can tell by the oil price, right? The oil price is going down, right? And when usually conflict in the Middle East, it pushes the oil price up. The oil price has been going down, and it's because it's been very contained. Now, if things get more heightened, if other states start saying stuff and become involved, then that's a concern. That's a worry, because then that could impact onto the supply of oil and then have other impacts as well. But at the moment, as horrible as the situation is, it's kind of contained to where it is, and markets are like, okay, we're okay with that. We've priced that. We've priced the risk already in. Okay. Any other questions? That seems to work for you, Jim. No? Okay. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. I'll be back with you tomorrow for another Bull versus Bear webinar. Until then, take care, stay safe.